You know, we saw the Hang Seng extending declines. As we heard from Carrie Lam, there are no dip buyers.
Yes, I mean, I guess the initial knee-jerk reaction there, but still some clarity to come, as your correspondent noted, I think, around the rumoured lockdown and mass testing. So further news to come, and we'll see how the market reacts to that. But clearly it's going to remain quite challenging in the near term for Hong Kong, and that's being reflected.
At this point in time, is there anything you're liking at all? I mean, valuations are cheap. I mean, we're looking at the Hang Seng and the CSI 300 index at 52-week lows. PE below 1.
Yes, I think there are opportunities on that market. We tend to focus on the companies that are listed in Hong Kong but have their operations overseas, and so are still enjoying strong growth or reasonable growth elsewhere, but are being beaten down by the sentiment in Hong Kong. So there are quite a few of those sorts of stocks that we hold, and this could be an interesting opportunity to take another look at those.
And when you take a look at the broader market, you know, there's something new every day for investors to consider. Do you keep cash?
It's look, it's hugely volatile. It is challenging to navigate through this. Cash is tempting, but in an inflationary environment, that's not ideal either. I think it's time for diversification across sectors, across asset types. And for us, it's all about focusing on quality, really. So these are the companies that are best positioned to weather the uncertainty, to weather the volatility, whether they've got a strong balance sheet, healthy cash flows. So I think there is going to be a bit of a rotation into quality names, and that's a good place to be at the moment.
But let's move things along and have a look at what's going on in the rest of the world, where COVID is not quite such a big issue. One other thing is, of course, and it's Ukraine. And give us a sense, as a long-term investor, how this is changing perhaps your strategy looking ahead.
Yes, well, we're obviously having to think quite carefully about the positioning of our portfolios in the near term. The most obvious impact is on the inflationary side, and with commodity prices rising, we're seeing quite a bit of input cost pressure for a number of our companies and margins getting squeezed. So that's clouding the earnings outlook and causing us just to recalibrate a little bit within portfolios. Having said that, I do feel that Asia is in a slightly better place than much of the rest of the world. Certainly when you look at that energy dependency linkage, Asia is in a better position. And also, you know, it's coming from a place of lower inflation anyhow, and a sort of monetary policy framework that's been far more orthodox in recent years. So yes, it's challenging, but overall, I do feel that Asia is less severely impacted at this point.
James, it's not just about energy prices, it's about the whole commodities complex here, which is going to lift up prices. Food in particular, the thing there is then, what does that do for consumption? And consumption may be hit, and how badly is the big question.
Yes, it's a good question. And I think realistically, we should expect that growth is going to slow, and some of this will be consumption driven. But having said that, there are still pockets of pretty healthy growth, and even within the sort of broader consumer sector, I think there are decent opportunities within the Asia region. So yes, the headwinds are gathering. Yes, it's got more challenging. And I think you just have to be far more selective in this sort of environment. And as I said, quality companies feels to us to be the right place to be at the moment. But ultimately, it's a case for active stock picking, trying to avoid where the pressures are most intense, and building a portfolio from the bottom up along those lines.
James, interesting to see your conviction calls. That includes bullish on banks. Surely that must have changed given where we are right now. We have Fitch coming out to say that, you know what, Asian banks in particular have not factored in a possible default in Russia.
Yes, I think that, I mean, the view there is evolving. Clearly, there's a default risk. I mean, I think the linkages for Asian banks to that Russian default is much reduced versus certainly European banks. And we're seeing, you know, as I said, growth potentially slowing, and uncertainty now on the pace of interest rate hikes, which was buoying the share prices going into the beginning of this year. So it's less straightforward. I think the one thing that is in favor of certainly of Asian banks is that whilst we're not seeing it in Hong Kong or China yet, a lot of Asia is now reopening, and there is that sort of reopening tailwind that is helping to sort of provide a buffer to some of those headwinds. And so I think the banks will continue to benefit from that.